The Ferreira Avelar shoe company near Porto is so busy it has to farm out work. Next year, it'll build an extension to the factory and increase production 20%. Ruben Avelar, a third-generation owner, says growth came from new markets.
We get into China because we never saw China as a threat. We always saw China as an opportunity.
Ferreira Avelar is a Portuguese company that stayed in business even after Asian competitors laid waste to industries like textiles and its very own shoemaking. That's partly why the economy grew an average of just 1% over the past decade. Trouble for the government began when spending to spur growth during the financial crisis sent the budget deficit soaring, prompting speculation the country would succumb to a Greek-style collapse. Markets demanded austerity. Chronically slow economic growth is a problem for the government in preparing its budget for next year, because any expenditure cuts that it puts in place are going to hurt growth, and that's going to make it that much more difficult for it to reach its budget deficit targets. The government is now looking to the private sector to generate income and lower debt. And companies are looking beyond Europe for expansion.
From exports, growing exports, to southern emerging economies, fast-growing economies in Africa, Latin America, for example.
And is that happening?
Yeah, this is not just wishful thinking. This is going on right now.
That's being borne out in the numbers. They show manufacturing orders from within Portugal are falling, while demand from outside the country is increasing. Back at Ferreira Avelar, they can't pack shoes fast enough. Proof that efforts by some companies may begin to pay off for Portugal's economy. David Tweed, Bloomberg, Lisbon.